September 15, 2008. A date etched into financial history. Lehman Brothers, a venerable institution on Wall Street with 158 years of operation, filed for Chapter 11 bankruptcy. Its collapse was not merely a failure, it was the trigger for a global financial crisis, unprecedented in modern times. But the roots of this cataclysmic event were not sudden. They stretched back years, woven into the fabric of complex financial instruments and aggressive risk-taking, all amplified by a relentless pursuit of profit in a booming market. To understand the collapse, we must dissect the specific financial mechanisms that built its vulnerability. In the early to mid-2000s, the American housing market experienced an unprecedented boom. Low interest rates and a cultural shift towards home ownership fueled a seemingly insatiable demand. Traditional lending standards began to loosen, giving rise to what became known as subprime mortgages. These loans were extended to borrowers with less than stellar credit histories, often requiring minimal documentation or down payments. Investment banks, including Lehman Brothers, saw an opportunity to capitalize on this expanding market, viewing it as a new frontier for substantial returns. The perception was that real estate values would only continue to climb. Central to Lehman's strategy, and indeed much of Wall Street's, was the use of mortgage-backed securities, or MBS. These financial instruments were created by bundling thousands of individual mortgages together and then selling shares of these bundles to investors. The idea was to diversify risk. If a few mortgages defaulted, the overall pool would remain sound. However, as the market increasingly relied on subprime loans, the quality of these underlying assets deteriorated. Lehman Brothers became a significant player in the origination, underwriting, and trading of these complex securities, often taking large positions on its own balance sheet. Lehman Brothers, under the leadership of Richard Fuld, aggressively expanded its real estate holdings throughout the mid-2000s. This wasn't limited to just trading MBS. The firm directly invested in commercial real estate projects, land development, and even acquired several mortgage lenders, effectively integrating aspects of the subprime origination business. Sources close to the firm at the time described an environment where real estate bets were encouraged, fueled by a belief that the property market was fundamentally strong and its growth trajectory would continue indefinitely. This strategic pivot significantly increased the firm's direct exposure to the housing sector's volatility. To amplify returns from these real estate and MBS investments, Lehman Brothers utilized high leverage. Leverage, in finance, involves borrowing money to magnify the potential gains from an investment. For every dollar of its own capital, Lehman borrowed many more. During reported periods leading up to the crisis, this ratio exceeded 30-1. This meant that a small increase in the value of their assets could lead to massive profits. However, the inverse was also true. A minor decline in asset values could wipe out a significant portion of the firm's equity, creating immense vulnerability. The immense leverage employed by Lehman was a key accelerant of its eventual downfall. While it provided spectacular returns during the housing boom, it transformed any minor market fluctuation into a significant balance sheet event. Financial analysts at the time, though perhaps underestimating the subprime risk, noted the growing reliance on debt. One report, later critical of the firm's practices, highlighted that Lehman's balance sheet became increasingly sensitive to even fractional percentage shifts in asset prices. This meant that the institution, despite its size, was operating on incredibly thin margins of error, effectively betting its entire existence on the sustained health of the real estate market. By late 2006 and early 2007, cracks began to appear in the seemingly invincible housing market. Foreclosure rates on subprime mortgages started to climb. Borrowers, many with adjustable-rate mortgages, faced payment shock as their introductory low rates reset to higher levels. The values of the underlying homes, which were supposed to support the subprime loans, began to stagnate and then decline. This had a direct and devastating impact on the mortgage-backed securities that Lehman Brothers held in vast quantities. The assets that once generated significant profits now looked increasingly precarious. As the housing market deteriorated, the value of Lehman's massive portfolio of subprime mortgage-backed securities plummeted. These assets, once considered prime collateral, were now seen as toxic. The intricate models used to price these complex securities proved to be flawed, based on assumptions of continuous housing appreciation. As the defaults mounted, the diversification promised by MBS proved inadequate, especially in pools heavily concentrated with subprime loans. This meant Lehman was holding assets rapidly losing value, yet still carried on its books at inflated prices, a looming problem for its financial statements. The high leverage that once boosted Lehman's profits now magnified its losses exponentially. A 5% decline in the value of its MBS portfolio, for example, could translate into a 150% hit to its equity, given a 30-to-1 leverage ratio. This created a rapid erosion of the firm's capital base. As assets declined in value, creditors began to demand more collateral or refuse to roll over short-term loans, creating a liquidity crunch. Lehman found itself in a dangerous spiral. Asset values fell, leverage amplified losses, and confidence from lenders and investors evaporated, threatening the very solvency of the bank. As the crisis deepened in 2007 and 2008, Lehman Brothers faced intense pressure to reduce its exposure to risky assets and raise capital. The firm attempted to sell off its most problematic real estate holdings and mortgage securities, but the market for such assets had largely frozen. Buyers were scarce, and those willing to purchase demanded steep discounts, further crystallizing losses for Lehman. Despite these efforts, the firm's balance sheet remained bloated with illiquid, declining assets, and its leverage ratio, though perhaps fluctuating, remained dangerously high, a constant source of concern for regulators and investors alike. In the face of these growing pressures, Lehman Brothers increasingly relied on the repurchase agreement market, or repo market, for short-term funding. In a repo transaction, a firm sells securities to an investor with an agreement to buy them back later at a slightly higher price. It's essentially a collateralized short-term loan. The repo market is vital for financial institutions, providing daily liquidity. However, a specific type of repo transaction, known as Repo 105, would later come under intense scrutiny for its role in obscuring Lehman's true financial health. Repo 105 was not a standard repo transaction. The critical difference lay in how it was accounted for. Under specific U.S. accounting rules and the guidance of its auditor, Ernst & Young, Lehman Brothers classified certain repo transactions not as secured borrowings, loans, but as true sales. This reclassification was permissible if the value of the collateral transferred exceeded the cash received by at least 5%, hence a 105%. This seemingly minor accounting distinction had profound implications for Lehman's public financial statements, allowing it to manipulate its reported leverage and debt levels. Here's how Repo 105 worked. Just before the end of a financial reporting quarter, Lehman would sell roughly $50 billion of its least liquid assets, often its declining real estate and MBS holdings, to other financial institutions through Repo 105 transactions. Because these were accounted for as sales, the assets were temporarily removed from Lehman's balance sheet, and crucially, the associated debt used to fund those assets also disappeared. This artificially reduced Lehman's reported net leverage and total assets for a brief period, creating a false impression of a healthier financial position. The primary objective of Repo 105 transactions, as later revealed in reports by the bankruptcy examiner, was to mask Lehman Brothers' true financial condition from investors, creditors, and the public. By temporarily shifting debt off its balance sheet, the firm could present lower leverage ratios and higher liquidity figures in its quarterly and annual reports. This made Lehman appear less risky and more stable than it actually was, helping to maintain confidence and attract continued funding, even as its underlying asset quality deteriorated. These transactions were consistently reversed just after the reporting period, bringing the assets and debt back onto the books. Reports by the bankruptcy examiner, Anton Valukas, following Lehman's collapse, detailed the consistent and systematic use of Repo 105. Valukas concluded that these transactions were not accidental or isolated. Instead, they were a deliberate strategy employed by Lehman senior management and its accounting department, with the awareness of its auditors, to manage perception. This pattern of a window dressing occurred quarter after quarter, indicating a deeply ingrained practice to temporarily inflate the appearance of financial health when reporting to the market. The practice was later deemed materially misleading by the examiner. Lehman Brothers auditor, Ernst & Young, played a critical role in the Repo 105 controversy. According to the Valukas report, Ernst & Young approved Lehman's accounting treatment of Repo 105 transactions, effectively validating the firm's ability to classify these as sales rather than financings. This approval provided Lehman with the veneer of legitimacy for a practice that artificially improved its balance sheet. While Ernst & Young maintained its adherence to accounting standards, the examiner's report raised serious questions about the auditor's judgment and its failure to challenge a practice designed to obscure financial reality. By early 2008, the subprime mortgage crisis had intensified dramatically. The securitization market, where MBS were traded, seized up. Investors lost faith in the ratings assigned to these complex instruments, realizing that many were backed by increasingly worthless loans. This loss of confidence meant that there was no longer a functioning market to accurately price or offload these assets. Lehman, already burdened by its aggressive real estate exposure and high leverage, found itself trapped with a portfolio of assets whose values were in freefall and which it could not easily sell. As asset values declined, Lehman's leverage ratio effectively skyrocketed, even if reported figures tried to mask some of it. With its equity base shrinking rapidly due to mounting losses, the proportion of borrowed money relative to its own capital became unsustainable. This put immense pressure on the firm to raise new capital, but in a declining market, investors were wary of buying into a company so deeply exposed to toxic assets. The debt that Repo 105 temporarily hid became a permanent and growing burden, as the underlying assets continued to lose value, pushing the firm closer to insolvency. While Repo 105 offered a temporary reprieve from scrutiny, it did nothing to address the fundamental problems plaguing Lehman Brothers. It was a tool of perception management, not a solution to its underlying financial distress. As the subprime crisis deepened, the sheer scale of Lehman's exposure to illiquid and devaluing assets became too large for such accounting maneuvers to effectively conceal. The market, though perhaps unaware of the exact nature of Repo 105 at the time, sensed the deepening troubles, and confidence in Lehman's reported figures began to wane, making it harder for the firm to raise essential short-term funding. The combination of plummeting asset values, amplified by high leverage, and a market increasingly unwilling to lend, created a severe liquidity squeeze for Lehman. Short-term lenders in the repo market, once a consistent source of funding, grew wary. They began to demand higher collateral, larger haircuts, or simply refused to lend to Lehman altogether. This made it incredibly difficult for the firm to meet its daily funding needs, signaling to the wider market that Lehman was in deep trouble. The ability to roll over short-term debt became critical, and this lifeline was rapidly constricting. In the frantic days leading up to September 15, 2008, intense negotiations took place behind closed doors, involving government officials, the Federal Reserve, and other major financial institutions. The goal was to orchestrate a private sector rescue, similar to the one arranged for Bear Stearns earlier that year. Potential buyers, including Bank of America and Barclays, scrutinized Lehman's balance sheet. What they found was a mountain of illiquid assets, primarily its subprime MBS and real estate holdings, whose true value was uncertain, and a debt load far greater than publicly reported figures suggested. No buyer was willing to take on such a burden without significant government guarantees. Unlike Bear Stearns, for which the U.S. government facilitated a rescue, the decision was made not to bail out Lehman Brothers. Policymakers, including Treasury Secretary Henry Paulson, were reportedly concerned about setting a precedent of moral hazard, where firms would take excessive risks assuming they would always be saved. Without a buyer and without a government backstop, Lehman Brothers was left with no options. The sheer scale of its exposure to subprime assets, its towering leverage, and the lack of confidence exacerbated by its obscure debt made it impossible to save. On Sunday, September 14, 2008, negotiations officially collapsed. Without a buyer and without government assistance, the once mighty Lehman Brothers faced an inevitable fate. The next morning, Monday, September 15, the firm filed for Chapter 11 bankruptcy protection. It was, and remains, the largest bankruptcy filing in U.S. history, with over $600 billion in assets. The news sent shockwaves through global financial markets, immediately triggering panic and a dramatic tightening of credit worldwide. The specific mechanisms of Lehman's downfall, subprime exposure, high leverage, and balance sheet opacity coalesced into a single, devastating event. The immediate aftermath of Lehman's bankruptcy was one of widespread panic. Stock markets around the world plummeted. Credit markets froze as banks became deeply distrustful of each other's solvency. The interbank lending market, crucial for daily financial operations, seized up, threatening to bring down other institutions. The fear was palpable: if Lehman, a major investment bank, could fail, who was next? The crisis quickly spread beyond Wall Street, impacting pension funds, corporations, and individuals globally, demonstrating the interconnectedness of the modern financial system. Lehman's failure quickly evolved into a global contagion. European banks, many of which had exposure to U.S. subprime assets and had lent to Lehman, faced their own crises. The lack of trust in financial institutions' balance sheets led to a drying up of liquidity across borders. Central banks worldwide were forced to inject massive amounts of capital into the system to prevent a complete collapse of global finance. The crisis exposed the systemic risks inherent in complex financial instruments, high leverage, and the lack of transparency in reporting, lessons that would reshape regulatory frameworks for years to come. The official report by bankruptcy examiner Anton Valukas, released in March 2010, offered a detailed postmortem of Lehman Brothers' downfall. It meticulously documented the firm's aggressive expansion into risky real estate, its reliance on unsustainable levels of leverage, and critically, the systemic use of Repo 105 transactions. The report concluded that these transactions were deliberately used to mislead investors about Lehman's financial health. It highlighted a culture within Lehman that prioritized short-term appearances over long-term stability, even as the housing market signaled imminent danger. The Valukas report reignited a fierce debate within the accounting profession regarding the appropriate classification of such repurchase agreements. Critics argued that the true sailed treatment of Repo 105 was a loophole that allowed companies to manipulate their financial statements without breaking the letter of the law. Proponents, including Ernst & Young, defended the accounting treatment as compliant with prevailing standards at the time. Regardless, the controversy spurred calls for greater transparency and stricter accounting rules regarding temporary asset transfers and the reporting of debt, ensuring that the true financial picture is always presented. The astonishing leverage ratio of over 30-to-1 employed by Lehman Brothers brought the concept of financial leverage into sharp focus for regulators. While leverage is a fundamental tool in finance, its unchecked application in a highly volatile market proved catastrophic. The crisis led to widespread calls for stricter capital requirements for financial institutions, ensuring they hold more of their own capital relative to their borrowed funds. The aim was to create greater buffers against asset value depreciation and reduce the systemic risk posed by highly leveraged entities, preventing a repeat of Lehman's rapid capital erosion. Lehman's massive exposure to subprime mortgage-backed securities served as a stark lesson on the dangers of concentrated risk in complex financial products. The inability to accurately price, manage, and ultimately offload these assets underscored the fragility of financial innovation when divorced from sound underwriting and transparency. The subsequent reforms aimed to improve the securitization process, enhance transparency in MBS markets, and strengthen oversight of rating agencies. The collapse underlined that the stability of the entire financial system depends on the quality and integrity of its foundational assets. The Lehman Brothers collapse, and the ensuing global financial crisis, were instrumental in shaping the Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010. This landmark legislation sought to prevent future crises by addressing the very mechanisms that brought Lehman down. It introduced stricter regulations on financial institutions, enhanced oversight of complex financial products, and mandated greater transparency in derivatives markets. It also established the Financial Stability Oversight Council, FSOC, to identify and respond to systemic risks, aiming to prevent any single firm's failure from triggering another global meltdown. The reverberations of Lehman Brothers' bankruptcy are still felt today. It fundamentally reshaped the landscape of investment banking, leading to a consolidation of power among the remaining large institutions. More importantly, it forced a re-evaluation of how risk is managed, how leverage is controlled, and how financial statements are scrutinized. The legacy of Repo 105 continues to serve as a cautionary tale about accounting transparency and the pressures firms face to present an optimistic financial picture, even as underlying realities suggest otherwise. It remains a powerful reminder of systemic vulnerability. The Lehman Brothers story is a complex tapestry woven from aggressive market bets, sophisticated financial engineering, and the systemic vulnerabilities of an interconnected global economy. Its collapse wasn't due to a single failure but a confluence of factors, each exacerbating the others: an over-reliance on a booming, yet fragile, housing market, amplified by excessive leverage, and obscured by creative accounting. Understanding these specific mechanisms is crucial to comprehending not just the crisis of 2008, but the perennial challenges of financial regulation and the pursuit of stability in volatile markets. The leverage employed by Lehman Brothers underscores a fundamental lesson in finance: while it can accelerate wealth creation, it equally accelerates wealth destruction when markets turn. The firm's over 30-to-1 leverage ratio meant that it had very little margin for error. When the value of its subprime mortgage-backed securities began to decline, the sheer volume of borrowed capital meant that even small percentage losses quickly translated into an existential threat. This relentless amplification of risk became a primary driver of its insolvency, a critical point in the chain of events. Lehman's aggressive pursuit of returns led it to amass an enormous, concentrated exposure to subprime mortgage-backed securities. This decision, made during a period of perceived prosperity, ultimately became its Achilles heel. The assumption that housing prices would perpetually rise proved catastrophically wrong, leaving the firm holding vast amounts of illiquid, declining assets. The lack of transparency within the MBS market, coupled with flawed ratings, meant that the true risk of these securities was consistently underestimated, trapping Lehman in a portfolio that became unsellable and toxic. The use of Repo 105 transactions stands as a stark warning about the incentives and pressures within the financial industry to present an idealized version of financial health. While not illegal at the time, its intent to temporarily move debt off balance sheet to mask true leverage was later deemed misleading. This practice highlighted the need for accounting standards to keep pace with financial innovation, closing loopholes that allow for such window dressing. It underscored that true transparency is paramount for maintaining investor confidence and preventing systemic risks from quietly accumulating. Ultimately, the collapse of Lehman Brothers was a tragic culmination of these three key financial mechanisms interacting in a destructive feedback loop. Aggressive exposure to subprime MBS created the initial vulnerability. High leverage then amplified every drop in the value of those assets, rapidly eroding the firm's capital. And Repo 105, while delaying the inevitable and misleading observers, ultimately failed to prevent the implosion. It was the interplay of these specific practices, rather than any single one, that made Lehman too fragile to withstand the gathering storm. The story of Lehman Brothers serves as a powerful, enduring legacy of caution for financial markets. It reminds us of the delicate balance between innovation and risk, profit and stability. The mechanisms explored, subprime MBS, extreme leverage, and creative accounting like Repo 105, are not just historical footnotes, they are enduring principles that must be understood and monitored to safeguard the global economy. By dissecting this specific financial collapse, we gain insight into the structural weaknesses that can, and did, bring a titan of Wall Street to its knees, with repercussions felt across the world. Beyond the financial statistics and complex mechanisms, the collapse of Lehman Brothers had a profound human cost. Thousands lost their jobs, careers were shattered, and public trust in financial institutions plummeted. While the focus of this analysis has been on the specific financial tools and decisions, it's crucial to remember that these abstract concepts translated into very real, tangible hardships for individuals and families worldwide. The repercussions continue to shape economic policy and public sentiment, ensuring that the lessons learned from Lehman's fall are not soon forgotten. The collapse of Lehman Brothers was more than just a corporate failure, it was a moment of reckoning for the global financial system. It laid bare the perils of unchecked ambition, the fragility of complex financial instruments, and the critical importance of transparent and rigorous accounting. The mechanisms of massive subprime exposure, extreme leverage, and the deceptive practices of Repo 105 formed a potent cocktail of risk that ultimately proved fatal. Its story remains a compelling narrative, a testament to how specific financial decisions, amplified by systemic factors, can send shockwaves across the world.